So exercise number 5, Mega Cola faces demand or a demand of 2,200 minus 20 times P. Its costs are constant at $5 per unit. So Mega Cola is a monopolist here. So just for your information, exercise or sub-exercise A show that Mega Cola will not change its behavior if the government introduces a 20% tax on its profits. Okay, so this is 5A. So in optimum, it always holds that the marginal benefit or the marginal return sometimes is equal to the marginal costs. Both do not get affected by a tax rate on profits. And we will see this if we want to calculate what is going to happen if there is a 20% tax rate on profits. So what we first need to get is the inverse demand function, so the price depending on the quantity. So step 1, determine inverse demand. So since the company is a monopolist, it can either choose the price or the quantity, so it doesn't matter for the final result, but it's easier to work with the quantity since the costs here are expressed in terms of quantity. So we first need to determine the inverse demand, so not the quantity as a function of the price, but the function as the price of, the price as a function of the quantity. So Q is equal to 2,200 minus 20 times P. And if we solve this for the price, what we get is that the price is equal to 110, minus 0.05 times Q. And this is now the inverse demand. And with the inverse demand, we can calculate the margin, the revenue. So the revenue, or step 2, is the marginal revenue. This is what we need now. So the revenue is simply quantity times the price. And now if we plug in for the inverse demand that we calculated here, the revenue is now a function of the quantity only and does not depend on the price directly anymore. So it's then 110 times Q minus 0.05 times Q by the power of 2. And the marginal revenue is simply the derivative of the revenue function. So the marginal revenue is then simply 110 minus 0.1 times Q. Now we got everything that we need in order to calculate the optimal quantity which will be produced by Mega Cola, because in step 3 we now determine the optimum by setting the marginal costs equal to the marginal revenue, and the marginal costs were given to us in the exercise description. So it was $5, so 5, and this is supposed to be equal to 110 minus 0.1 times Q. And if you solve this equality for Q, what you get is Q star is equal to 1050. So 1050 units will be produced. And if you plug this into the final profit, so the profit, or before we come to the profit, we need to determine the price. Sorry, this is something that we need as well. So therefore, the price, P star, is then simply given when you plug in the quantity into the inverse demand function, and what you get then is $57.50. So this is what you get as a price in this market, and then the profits. The profits are then given by P star times Q star minus the costs, so which was then Q star times 5. So what you get at the end is $55,125. This is the final profit, and only now do you apply the tax rate of 20%. I think it was 20%. Yes, on the profits. And since it's applied on the end and not on the revenue, like on the profit and not on the revenue or anything else, it only changes the final profit that the firm is getting without changing its behavior, because as I showed you before, neither the marginal benefits, the marginal revenue, nor the marginal costs are getting affected by a tax on the profits. So there are no distortions happening here. And this brings us actually immediately to sub-exercise B. So just to summarize it, a tax on profits. A tax on profits does not change the quantity, or does not change, let's be more general, that does not change the behavior of the firm with respect to production. And this brings us to sub-exercise B, where we are asked the following. Does the existence of firms such as Mega-Cola strengthen or weaken the case for a corporate income tax? Explain. So now we're basically asked to discuss the benefits and disbenefits of the tax that we introduced in sub-exercise A. So the positive points, so the pros are the following. So there is no distortion. The tax does not change the underlying behavior of the firm. Yes, so since there is no distortion happening, it means that the tax is not changing the quantity which is produced in optimum, because the tax will only be applied on the profits. So this means that the tax is efficient since there are no distortions created. That's the pro of this tax, basically. Yeah, so in such a case, there is kind of a strengthening of the corporate income tax rate. In addition, the tax kind of is basically, if you want to say it like this, it's basically a little bit progressive. So put this into the marks here because it's not really progressive, but in some extent it is because um, firms who make the most profits pay kind of most taxes here. So this is since firms with the most profits sell, or not sell, of course, it's not sell, but pay the highest amount of taxes. Okay, so this is basically also a pro because then if you have firms which are steadily making profits over the years, those are the firms which are paying most of the taxes, and firms which are making lower profits or are even making losses, they are not paying taxes. So it's kind of progressive by taxing only the firms uh, who are basically making the highest profits. Yeah, so those are the pros. Of course, there are also cons, like contras. So one is that if Mega Cola has entry costs or had entry costs, if it had entry costs, so fixed costs, the tax could have prevented it from entering into the market at the first place. So the tax could have what did I just wanted to say? So if Mega Cola had entry costs, fixed costs, the tax could have prevented, this was the word I was searching for, so prevented it from entering at the first place. So what do I mean by this? So when a company is deciding whether to enter a market or not, it's basically estimating the profits that it will do in this market. So profits neglecting the fixed cost of entry. Now, if these profits are basically need to be taxed, it means that the final profit of the firm will be lower compared to a situation without the tax. So what could happen is that the fixed costs are almost as high as the profit without taxes that the firm would make. And if you apply taxes on the profits, which do not include the fixed cost, it might basically prevent this firm from entering at all, even though it could be efficient for the firm to enter. Yes, so even though there are no distortions with respect to the behavior of the firm when it's about production, there are distortions with respect to the entry decision of the firm. Yeah, and this is one of the contrasts um, of the company. In addition, the second one, which is maybe a little bit related, is that it could prevent or could reduce investments by Mega Cola. Okay, so this is also an issue because investments could be, for instance, investments into to be more efficient, so reducing the costs, or investments could also be related to innovation of the products which are sold, which could also be welfare improving or enhancing. Therefore, if you and all of those investments are financed by profits, and if you apply the tax rate on the profits, there could be a reduction of investments by Mega Cola. So there wouldn't be any investments to become more efficient, or there wouldn't be any investments to be more innovative, which both would be welfare enhancing. Yeah, so those are the contours of such a tax. So then in total, obviously, it depends on the particular market and of course, obviously, on the height of the tax rate, whether it is welfare enhancing or not. And this brings us to the last exercise for this week. is exercise number 6. So this is a little bit related to, I think, question number 3 or 4. So suppose that the corporate tax rate is 25%. There is an investment tax credit of 10%. The depreciation rate is 5% and dividend yield is 10%. The official depreciation schedule is such that the present discounted value of depreciation allowance is 40% of the purchase price of the machine. In sub-exercise A, we are faced with the following task. So calculate the per period marginal costs of each dollar that the firm spends on the machine. Okay. So let's go to the last page. So this is exercise number 6A. So if there is no taxation, the marginal cost would be equal to depreciation plus dividend yield. Yeah. So if there is no tax, the marginal costs, which are shortcut by MC, is depreciation plus dividend yields. So it would be here 5% plus 15%, plus 10%, which is equal to 15%. So the corporate tax rate of 25%, it does not change the cost of investment, but the investment tax credit and the present discount value of depreciation depend on the corporate tax. So they will be affected by the corporate tax rate. So depreciation generates a deduction from taxes and lowers the cost of investment by the corporate tax rate times the present discount value of the depreciation. So here it's basically given in percentage as described in the exercise description. So it's then 0.4 times, this is the present discounted value in percentage of the investment, so 0.4 times the corporate tax rate, which is 0.25, so it's 0.1. Okay, so then the investment tax credit, which is shortcutted by ITC, it lowers costs by another 10%. So 0.1. So what we then get finally, we get as the calculation, so the marginal costs are then depreciation, which is 0. So no, let's write it in words first. So depreciation plus dividend yield this will be multiplied with 1 minus the corporate tax rate. I just need more space here. 1 minus the corporate tax rate so corporate tax times the present discounted value of the depreciation minus the investment tax credit. So it's then minus ITC. And if we plug everything in, so we have all those values, we get a marginal cost. So the marginal costs are equal to 0.12, so 12%. So for each dollar of investment, the marginal costs here are, so each dollar that the firm is spending on the machine, the per period marginal costs are 12% here, so 0.12 dollars basically. Okay, sub exercise B. If the marginal benefit per period is 40 minus 0.6 times K, where K is the amount or the number of dollars spent on the machine, what is the optimal amount of machinery purchased? So the marginal benefit here is 40 minus 0.6 times K minus 1 minus 0.25, because we have a corporate tax rate of 25%, so we need to subtract or account for this. And if you multiply this out, what you get is 30 minus 0.45 times K. And if we then set the marginal benefit equal to the marginal costs, which we calculated before, what we get is, so if you plug in everything, 30 minus 0.45 times K, this is supposed to be 0.12. And if you solve this, you end up with K star being equal to $66.40. Yeah, so this is the amount of dollars that you spend on the machine in optimum, such that the marginal benefit, when accounting for all the types of taxes and deductions that we have, is equal to the marginal costs. Again, the marginal cost then also being affected by the depreciation and the taxes that we have to pay. In C, there is a slight change. So in C, there is an increase in the interest. I'm always forgetting the name of this thing. So it's an investment tax credit. It's an investment tax credit. So it's now 20% instead of 10%. So then we simply use the formula that we had before. So in sub exercise B. And what we get then is that the new marginal costs are then equal to 0.15 times 1 minus 0.1 minus 0.20. Yeah, so the ITC increased from 0.1 to 0.2. Everything else is basically the same. And this will give us a marginal cost for each dollar that we invest in machinery of $0.105. So 10.5 cents. And now we basically do the same calculation as before. So we again set the marginal benefit equal to the marginal costs. And we get 30 minus 0.45 times K should be equal to 0.105. And if we solve this, we get K star equal to $66.43. Yeah, so because of the numbers in this exercise description, the increase is not very high here, but there is an increase in the amount which is invested because of the investment tax credit increasing. Yeah? And this affects your marginal costs in a negative way because it's decreasing them. Therefore, if your marginal costs are lower, you can invest more into the machinery. Therefore, you see an increase in this investment here. Good, and this finishes this week's problem set. So see you next week then.